Recently, interest rates rose yet again, but at some point we're going to reach what I call peak interest rates, where the Federal Open Markets Committee is achieving their goal. They're starting to see inflation come down, and hopefully we see interest rates as well as inflation start to come down. And when we reach peak interest rates, how does that impact you? Is there anything you need to change, right? If we look at over the last 12 or 15 months, the world's really changed a lot, right? Interest rates, certainly at the beginning of COVID, interest rates were incredibly low for a long period of time. The 10-year Treasury, which is a 10-year bond that the government issues, was paying less than 1%. Mortgage rates fell down below 3.5%. Most of us know somebody that was fortunate enough to get a 30-year fixed rate mortgage at 3% or less. That world doesn't exist now, right? So let's go for a walk. Let's talk about what's changed, and what does that mean maybe for your investments and for your retirement planning. So let's go for a walk. Okay, so I talked about mortgage rates. I talked about interest rates. You know, where they're at today is, you know, they kind of peaked out at over 7%. Right now, mortgage rate, a 30-year fixed rate is about 6.5% as I record this. The fixed rate for a 15-year mortgage is just under 6%. I believe it's like 5.8%. And just a couple days ago, 10-year treasuries were paying over 4%. So again, the world's very different, but what does this mean for your investments? Do you need to make any changes to your investments? So, you know, where I would open is, you know, have your financial goals changed? Has your asset balance changed? Has something in your life changed? You know, have you found out, you know, maybe you've got an illness and so you're not planning for as long of a time as you might have been a couple years ago. But you know, if nothing's changed in your goals and nothing's changed in your life, you know, the answer is if you set your long-term allocation properly at the beginning, it was designed for this. It was designed for periods of turmoil like we're seeing right now and of uncertainty like we're seeing right now. So the short answer is, from an asset allocation standpoint, probably no change, but there's probably opportunities that you should be thinking about. One of those opportunities is, you know, if you got your mortgage in the last couple years and you're paying 5-6%, you know, if we reach peak interest rates, that's going to be an opportunity maybe to refinance. And I have a video on refinancing. I'll link to it up here, where you can find out more about refinancing and how to do that in a cost-effective way. I'm not a real estate broker. I just in that video share what my experiences have been. But that's one opportunity. Another opportunity is, yield, which is income off of your portfolio. Yield is much easier to get today than it was 3 years ago. You know, the last 7 years plus have been really challenging to get yield. So there's opportunities to get income. You don't want to stretch too long. You don't want to lock up what seems like attractive interest rates for too long of a period of time, because you could be wrong. Interest rates might go higher. We may not be as close to peak interest rates as we think. In fact, interest rates are famously one of the hardest things to forecast. And Warren Buffett has a saying, and I think it's very true, that, you know, forecasts tell you more about forecasters than they do about the future. And that's never been more true than in the space of interest rates, because it's just so hard to get interest rates right. So yield is an opportunity. Refinancing is an opportunity for you. And I also think the risk profile of the American economy looks different today than it did a couple years ago. And one of the reasons for that is what's called the inverted yield curve, which is just a fancy way to say that short-term interest rates are actually paying more than long-term interest rates. You know, normally, like if you buy a CD at a bank, normally if you buy a 6-month CD, it's going to pay less than if you locked up your money for 5 years. But we're in a weird time right now where short-term rates are actually higher than long-term rates. So that creates interesting opportunities, right? We can actually get a higher return on our money for short-term interest, short-term periods. And the reason is people think interest rates are going to go down, but who knows? I don't even think, Jerome Powell doesn't know. He's going to do, as he has famously said, whatever it takes to bring inflation under control. But I bring up this inverted yield curve because it has a dramatic effect on the economy, right? Because banks, again, we're putting our money in a bank and they're paying us interest rates, and then they're taking our money and they're loaning it out to people that maybe are going to take 5, 7, 10 years, or in the case of a mortgage, 30 years to pay back. But if they have to pay a higher interest rate to you and I to attract our deposits, if they're paying us a higher rate than what they can get in the long term with loans to other companies, that doesn't make sense, right? It's kind of the Saturday Night Live skit where they make it up with volume, but unfortunately they don't make it up with volume. So, if banks are paying us, I saw Schwab has a CD that's paying over 5% right now. Schwab, and Schwab has a bank, by the way, so it's not just a brokerage. Schwab has to find business loan opportunities that are going to pay even more because, certainly they don't want to loan out that money at the lower rates that longer term loans right now are paying, longer term bonds. So it's an interesting time for the economy, and things can kind of snowball very quickly. And that's the power that the Fed has with interest rates. And a lot of people would say maybe they've been too aggressive because that's such a big stick that they're waving, and it has all kinds of unintended consequences. So I do think the risk profile in the market right now is higher than it was 2 years ago. So that's something else to be cautious about. 2 years ago, we were floating in money. The U.S. government was trying to keep the economy going by pumping a lot during COVID, by pumping money into the economy, and we all had access to cheap capital, and that's gone now. So I think the risk profile has changed. Does that mean you change your asset allocation? I don't think so. Again, it depends on how it was set up day one. If your asset allocation was set up properly, and by properly, I mean it's really designed to help you weather scary times, and it's designed to be diversified, and it's designed to meet your liquidity needs. Now, this is not financial advice. It can't be financial advice because I don't know your situation. It's really financial education and some things for you to think about. But if your asset allocation was set up properly, then unless your life has changed, unless you say, hey, I thought I was going to want $50,000 a year in retirement, but I need $75,000, or unfortunately, I got diagnosed with cancer, and I have a shorter life expectancy now. So I want to take full advantage of the healthy years that I have. So asset allocations ideally should change when life situations change, not based on what the stock market's doing, not based on the economy. So, like during COVID. Or during the financial crisis, a lot of folks were calling up their financial advisor and saying, hey, what are you doing to protect me from this 30, 40, 50% drop? And, the answer we all want from our financial advisors, oh, I got you out of the market just before things collapse. So don't worry, you're in cash. Timing the market doesn't work. Time in the market does work, right? If you look at a stock chart, generally goes from over time, the lower left to the upper right, which is a good thing. But timing the market doesn't work. So, unfortunately, the answer that a good financial advisor is telling their clients during that period, what are we doing today to protect you from what's going on today? What we're doing is what we did years ago when we got the asset allocation right, and it allows, and the asset allocation getting right means it allows you to stay the course during scary times like this. Now, there might be some tweaks in the portfolio. You might say that because of what's going on, a company that you used to like maybe is not as solid with the current economic environment. For instance, during COVID, and this is an opposite example, COVID, we all got sent home, so we had needs for technology. And even though, in the early days of COVID, companies like Google and Apple, they were down 30%, 20, 30%. And the reality is, that was a tailwind for them because we all needed to upgrade our technology. I had what would now be probably a 14-year-old Apple laptop. It worked fine, allowed me to check my email. But when I started working from home, I couldn't do the Zoom calls and put up the fake background behind me, which, I was working in my basement. So I really didn't want that on Zoom calls. So the answer is, what was your financial advisor doing when scary times came? What they were doing is what they did years earlier when they got your asset allocation right. And then they serve as a river guide for you. But wrapping up on peak interest rates, have we reached peak interest rates? I kind of think we're getting close. But I also don't fool myself in thinking that I can forecast interest rates. And I know I could very well be wrong on that. And if we have reached peak interest rates, what are the opportunities for you? One, I talked to all of these. I'm just wrapping up here. All of these I've talked about. One is gives you a chance to lock in some yield. I wouldn't go too long term on that. I would keep things relatively short. I certainly wouldn't lock up my money for 10 years. You might be right. You might be glad 3 years from now, if interest rates are back down, that you have a 10-year treasury that today is paying closer to 3.5%. Or you might be sad, interest rates could go up. So yield is easier. Again, I would do high quality, short duration. This is not investment advice, but in general, high quality and short duration. If interest rates do go up, short duration is just bonds that come due in a year, 2 years, 3 years, etc. If interest rates do go up, it allows you to reinvest that money as the bonds come due. So high quality, short duration, to the extent you have a mortgage that where you're paying a higher interest rates. As interest rates go down, that gives you an opportunity. I do have a video on a technique that can lower the cost of doing refinances. You can watch it up here, or I'll link to it in the show notes. And then I think the risk profile of the economy right now is higher, and just be aware of that and make sure that your asset allocation is proper for you. And if you're just kind of winging that and doing it on your own, that can be an expensive experiment. Hopefully you got it right, but if you didn't get it right and you blow out at the bottom because it's too painful, that could really be expensive. So I urge you to make sure that your asset allocation is right. So I hope you found this video helpful. If you did, do me a favor, hit the like button, the thumbs up. It really does help the algorithm. It helps YouTube find other viewers that this channel can help. And as the kids say, thumbs for likes and subs for love. And I want to encourage you to leave a comment. I do read the comments every day. I find them very motivational. So thank you for those of you that are leaving comments. We're building a nice community here. Really supportive. Folks are answering each other's questions. I do want to caution you, though, there are some scammers in the comments. I will never reach out to you in the comments and say, hey, give me a call. I've got this business opportunity or this investment, or I know this mortgage broker that you should use. I would never do that. So just be careful. Use your common sense in the comments. So again, hopefully this was helpful. If it was, leave me a like. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use this time wisely.